Let's let a few more seconds go by or so before we dive in. Actually, maybe now is a decent time for me to do our opening disclaimer. I will close it by disclaiming also, because there's no question that it's an important part of the SEC's world. But anybody who is watching this, actually, for all those people watching this, please know, certainly I'm not an expert in real estate. PJ is. But this is educational. We're not giving specific investment advice or tax advice or legal advice. So if you have questions on any of these topics, obviously PJ and are always open to conversations with folks. But I figure you all should know this. We're not pitching a product of any kind or doing anything. We're just trying to be educational. So that's our goal. With that in mind, let's dive in. PJ, I thank you, everybody. First of all, hello to all who have spanned. We might have all 7 continents. I'm not positive. If at least probably 5. But welcome, regardless of your time zone. It's like when you get on an airplane and they say, "Hope you're flying to so and so to wherever." Right? The doors have already closed. Well, the doors are closing this. Hope you mean to be on the commercial real estate webinar. That is where you find yourself, and this is a topic that is certainly is on the front of the mind of some of our clients. You read about it in the financial press. It's a topic that has been, well, it's active enough that we thought we should do an educational event around it. So, and to that end, I'm Matt Pohlman. For those of you who don't know me, I founded East Franklin Capital a little decade and a half ago, and I'm an investment advisor. And that's it. That's my entire bio. That's my entire bio. I was born an investment advisor 15 years ago. But we do have, so I'm not an expert, but we do have somebody who's been in the commercial real estate industry for quite a while, PJ Doherty, local currently here to Wilmington. I know he's practiced. Actually, you've spanned the entire country with your real estate exposure. So I'll let you introduce yourself, and before we dive in and talk in a little more detail about real estate as a kind of where it fits in your investment portfolio. So PJ, introduce yourself.
Matt, thanks for the not only the introduction, but the invitation to join you. I know your firm has got a lot of accolades, and you certainly don't pat yourself on the back, but I know you've got some really incredible clients, and you do a great job. And so I'm just very appreciative of the invitation today. So good afternoon to you. My name is Patrick Doherty, commonly known, everybody knows me as PJ. I've been called that since I was a kid, and it just sticks. And it's a little easier to remember. And so the Carolina Commercial Investment Properties is my baby that I started 12 years ago this next month, in March. I am a CCIM, which is a Certified Commercial Investment Member. And a CCIM designation is kind of comparable to an MBA in commercial real estate. I decided to go down that path when I realized the importance of investment real estate and how integral real estate can be, not only as an investment for the short, but also for the long term. And it was just a place where I found my niche. I had a financial background. So I actually kind of follow in a path similar to yours and in financial advisory, but God's got a funny sense of humor, so here I am.
Good. Well, we're benefiting. I'm sure you would have been great whatever path you chose, but we are appreciative of you being engaged here, and I know you've been helpful to me and have given me some things to think about over the past few years. And actually, in some ways, this conversation is a function of. So what I want to kind of start us out with is really talk about investment. Is where if we're looking at the entire world of somebody's investments. So a portfolio, and we've got stocks and bonds, and and maybe real estate, or a variety of maybe precious metals. There are a variety of ways to put money to work to invest. I know a while back you sent me an article about kind of 2026, and maybe kind of what to think about as it relates to commercial real estate, because in some ways it's changed also, right? We've now got assets that are more digital assets, and server farms, and it's just and then that's always probably been true with commercial real estate, that it evolves, but we are in it now. And so to kind of frame this before we dive in specifically on some real estate terms and concepts and examples even. I look at commercial real estate, and I would also argue, and PJ, I mean, this maybe, if somebody owns a rental property, let's say they own a second house or a third house or a duplex, and they rent that out. That's probably not kind of technically commercial real estate, but it functions for them as commercial real estate, right? It's not real estate as a right.
It's still an investment property.
That's right. That's right. So when I say commercial, that I'm kind of lumping that last little piece in, just to kind of you describe its existence. It has got investment goals. It's whether it's income or diversification, whatever it is. So when I talk about commercial real estate, maybe we'll kind of throw that one in. That's the caboose on the train.
Yeah, I would be surprised if somewhere over the course of the next 45 minutes or an hour we didn't talk a little bit about residential real estate, and defining, but still, an investment portfolio, whether it's commercial or residential, there's a place for it. And sometimes it's just a little bit easier to get into a residential investment than it is a commercial, because typically speaking, commercial assets are just significantly expensive.
Yeah. And so if I think about these assets within the context of an overall asset allocation, I think about, whether it's, regardless of the asset class or type, all investments should have a purpose, and they should work as a team, right? So if an overall portfolio is a team of investments, then correlation matters. In fact, I have argued for years that, it's how assets correlate to each other. It might be their single most important characteristic. If all assets in a portfolio are highly correlated with each other, I'm not sure why you would have a bunch of assets, and why not just have a smaller number of assets. So it's like I think about correlation across the assets. I think about it, diversification, right? One investment versus many, and kind of what fits where, and even kind of within an asset class, right? And I'm sure we'll get into this, but so for commercial real estate, there are certainly different types of commercial real estate. So diversification even within an asset class. Goals of the asset, right? You've got assets that are in place to produce income, possibly assets that are maybe more speculative or have far higher kind of growth potential. Some assets that may be the kind of port in the storm, right? Maybe it's a treasury, right? So you've got those kind of considerations. Inflation, right? Inflation protection may be top of mind for a number of folks. Certainly something I think about. And certain assets can do well in an inflationary environment. Others might do poorly, at least historically. And the last item, nearest and dearest to me, for those who are on our previous webinar, taxes are important to me. Taxes are important to me. They really hit home, literally and figuratively. And so tax efficiency, and what a real estate asset can bring that a stock or a bond can. Just by their nature. So I wanted to make sure everybody who's on this webinar thinking about maybe where commercial real estate or real estate in general fits into their investment portfolio. Like those are the areas that we're kind of that's our lens. And by the way, that's the same lens as a stock or a bond or a fund. It's there are different characteristics, but that's our lens. And so I think that's kind of where I want us to jump off and get into it in a little more detail. And maybe the right way to step into it is to say, okay, if those are our goals, right? Let's just take one of them, like two, like correlation or an income versus growth, right? I'm sure there are assets that you work with where your clients say, this is for income. We are making this purchase. It's long term. We're going to put some debt on it. We're going to hold it. This is an income play for us. And you may have other clients that will say, we've got these other moving parts in our wealth. I'd like for something to be, consistent, and it's not going to go up and down with the markets, and those can be related, but they're two different goals. And so when somebody says to you, all right, how should I invest, or what should I think about in terms of commercial real estate? What's kind of the opener for you to say, well, here's how I think about it.
Well, it's probably not unlike the initial conversation you have with a new client who says, okay, first of all, what's your age? What are your goals? What's your current net worth or position, and where are you now, and where do you hope that to be? And do you have a retirement goal or a retirement age, and how are we going to go from where we are today to accomplishing those goals? So, whether it's potentially a high net worth couple who are having a conversation about legacy real estate, something that says, how am I going to pass this down to my family? And being the fact that we live in Brunswick County, the neighboring county, one of the fastest growing counties in the country, is driven by retirees. So we're seeing that baby boomer growth move to a conversation that's a little bit different than the one we had a decade ago of what can I leave behind for the kids, or what can I leave behind for the grandkids. So we're having that conversation quite a bit more often, but I think it really depends on where are you now in your career and in your age. And if you may just be starting out and you say, hey, look, really the only real investments I have in my portfolio is a 401k that was started with work. And now that's grown to be something that might need to be more professionally managed. And so, what should I do to diversify? You had talked about that in your opening statements, is how important it is to diversify. If you take Portfolio 101, no matter what class book you read, diversification is probably going to be in the first sentence, if not the first paragraph. So is how do we take advantage of real estate assets in your portfolio for the long term? And that may be stepping into buying your primary residence and buying your first house. We're seeing millennials actually leaning in towards renting and leasing more than they are back when our parents purchased their first home. As you graduated from school, got married, bought a house. Well, that's not the trend of the millennial and of the people that are following in our footsteps traditionally. So people are like, why are so many apartments being built? Well,
demand.
The demand is
demand
there,
for them.
And with the cost of housing being the highest it's ever been in the country, and interest rates went for a wild ride after we came out of COVID. But if you're creeping up on being a six-figure income earner and you don't have any write-offs, the write-off and the depreciation from that mortgage is an integral part, absolutely one of the most powerful tax benefits, no matter whether it's an entry-level home or it's a $50 million office tower. The depreciation of that asset is. So where is that component into your portfolio, and how much of that may you or may not be? And
PJ, on that point, just real quick. I mean, when you think about, let's say true kind of, commercial real estate, I'm assuming that the tax implications, depreciation is one of them. But I mean, also, do you think is the conversation, is that kind of dovetail with financing also? Do you feel like financing is a fundamental part of kind of this asset class?
Absolutely. And how easy is the financing? Leverage. As a matter of fact, I think I just saw 30-year mortgages right at the 6% mark. That's an attractive rate. You and I grew up listening to our parents talk about their first home. Their mortgage rate was like 14%.
Yep. Yeah.
I started in this business in mortgage banking, and people would come and be like, 8%, that's cheap. My first mortgage was 16, during the Carter administration.
Yeah.
So interest rates do certainly have a sensitive component to it, and the availability of that debt. Banking goes through cycles, just like all industries go through cycles. Liquidity is sometimes very available and sometimes not. And then the other question is perhaps it's somebody that is 2, 3, 5 years away from retirement, and they've got quite a nest egg, but do they have an income stream? What are you going to do for a paycheck when you say goodbye to your job?
Right. Yeah.
And so maybe we take some of the allocation from that 401k and say, hey, why don't we take some of this? You're heavily weighted in American Airlines, that's where you retired from, or Wells Fargo Bank, whatever career you had, you may be overly weighted in one particular sector. So why don't we de-risk that sector, take some of that cash off the table, and leverage real estate for an income stream so you have something that you don't keep whittling away on your savings.
Yeah. Yeah. It is true. I mean, it really is true that we've gone from a world of you retire with a pension. I mean, at least that was very, very common. We've gone. I mean, those are everybody. It's a fewer and fewer percentage of the total retiree population that has a pension. We still have Social Security. Who knows for how much longer? But we still have it now. We have it now. And so you think, okay, those are two consistent retirement. That's fixed income, right? People retire on fixed income, and in today's world, you've hit the nail on the head. If the bulk of retirement assets are in a 401k, let's say, right, and then it rolls into an IRA, that's not a. I mean, that's a single bucket. And there's no leverage opportunity. There's no, right. It's like, this is there is that's tough. And so you got to generate income from somewhere. And if all the assets are in an IRA, for example, that's a pretty tax inefficient way to have a retirement. And so to some extent, it's like, hey, well, you got to start planning while you can around. If I know ultimately I want an income stream, how do I get there? And it does seem to me, I mean, especially as bond yields are low, very low, maybe not historic lows, but they're low by generally speaking. You've got to generate income from somewhere. So the idea of generating from a bond is like, well, we're not. I mean, the 3.5% is not very appealing. And real estate can give you 2 or 3 times that potentially. And it's that's a beauty of this asset class. That
I think you hit the nail on the head when you're talking about the fact that the pension is a dying breed. Mm-hmm. I don't have a single friend who's going to get a pension.
Right.
I mean, maybe I do have to think about it. Maybe I have some teacher friends or somebody.
Right.
But it's probably not going to be enough for them to live on.
Right.
And so how would people who are self-employed, which is a large portion of our population and certainly a large portion of the high net worth individuals in our country, they're self-employed. There's no pension, right? Are you going to deal?
Nope. Right.
Franklin Street Capital have a pension plan? No.
Right.
So not only is it really a great way for you to say, okay, this is my pension. This asset or these commercial real estate assets are my pensions. That's where I'm going to create the income. And more importantly, the power comes in the fact that I've got a tenant paying off my debt.
Right.
I mean, it's one of the most powerful leverage investments that I know of. I can't go to the bank and say, hey, loan me $200,000. I want to buy stock in NVIDIA.
Right.
It's not an option.
Yeah. And in this case, you think about it to the point you just made, on that analogy also, there's also somebody, even if you could, you still have to cover the cost of your borrowing. Well, if you have a tenant, it's all right. I want to buy NVIDIA. And, oh, by the way, NVIDIA is going to help me on the way by covering my interest cost or whatever. I mean, it's pretty amazing. Even if an asset doesn't really, even if an investment asset doesn't grow, you buy something for $1 million, you sell it for $1 million. So 10 years later, you think, oh, I didn't do anything. Likely you got paid along the way. Very, very likely you got paid along the way. You even more likely, almost certainly, your tenant paid down your debt for 10 years. So you might have put $400,000 into $1 million investment, and 10 years later it sells for $1 million, $1.1 million. You think, oh, it didn't really do very much. Yeah, but instead of having $600,000 of debt, now you only have $300,000 of debt.
That's right. And when you clear that asset out, you went in, you put $200,000 in, and you're pulling $600,000 out.
Yep.
And of course, I need to be very careful about tax advice, but we didn't get into depreciation. depreciation on the mortgage rate, depreciation of the asset, the fact that you levered it with somebody else's money, and the fact that, again, somebody else was paying off that debt for you. And it's pretty rare. You probably somewhat got some bad advice or potentially positioned yourself in the wrong place. If you sell an asset 10 years from now for the same price that you went into it, I mean, the real estate values are really not that much different than looking at the Dow or the S&P. Go back 20 years, it goes up and down. There's a trend, whether it's
there's an upward slope, generally speaking. Right. Yep.
And so, hopefully you're in a hyper growth market, which, we're very fortunate in North Carolina, with Charlotte being one of the top cities in America, Raleigh being one of the top growth cities in America. You and I live in Wilmington because we know it's a wonderful, beautiful place to live. And this whole coastal region is one of the fastest growing places in the country. So highly unlikely you're going to spend $1 million 10 years from now, cash out for it. Well, even if you do, you still got your money back and somebody else was paying. Not to mention, again, the tax benefits of depreciating that asset.
The asset. Yeah, no, it's
they're associated with it.
Yep. Right. That's right. I mean, the tenant's covering all that. So if you think so, let's put a little bit of meat on this bone. Oh, that's not how meat works on a bone, right? The meat's already on the bone. But let's suspend reality. We're going to actually put meat on a bone. And kind of walk through maybe some examples. One might be, and again, I don't have a great sense of this, because what I see is so many opportunities ranging from a REIT, right? Clients will say, "Oh, we got REIT exposure," and there's a place for that. There's a place for that, and all the way to kind of maybe the other side, which is direct ownership of a single building, and then real estate's everywhere in between. I mean, like, literally the options. I mean, there are a lot of options between the single asset, the large single asset, all the way down to REIT exposure. Where do you see I mean, maybe there are opportunities across the entire spectrum, but where do you feel like people spend time? Where do you see opportunities, and how do you kind of quantify those what's in between there?
Well, we could spend, when you're talking about putting meat on a bone, this isn't a chicken bone.
No, this is
a whole hog. We could spend hours.
I don't feel like a hog is a very high bone animal. I mean, let's go beef.
Carolinas, we're barbecue.
That's true. Okay, all right. The whole hog. Let's go hog.
But at the same time, we could literally have a whole nother webinar on just that conversation. To be honest, there is REITs can be a great way to have exposure to certain asset categories, and some REITs actually have some diversification. Some have a little office and a little retail. And I think your background, you know quite a bit about managing REIT. That's part of your background and your career history. But
that's true.
The downside to that is that, yes, you have some exposure, but I'm not so sure that the real estate assets and the value of the real intrinsic assets held in that REIT and the stock price of that REIT correlate to one another. And you're not leveraging it, you're not depreciating it, and technically at the end of the day, you don't own real estate, you own a piece of mutual that holds real estate.
The REIT fund. Yep. Yeah.
And you could expand on that, but really more than me, because just with your history and your expertise in that particular category. So I think part of it is again, same conversation that you're likely to have with a new client is what's your risk exposure? Do we need to try to cover a lot of ground in a short period of time? Or are you already pretty much in retirement? We're not really into wealth generation. We're now moved to wealth preservation. And what are the asset categories that might fit best in that? And it's probably going to be something that's low risk, potentially a little bit lower return, but you know that you're going to get a coupon every month, whether it's a Chick-fil-A or a McDonald's or something that is, they're not going out of business. They're going to pay no matter what happens. And we hear a lot lately about multifamily. Apartments are getting a lot of dialogue. And part of it is some of them can be small enough that the individual investor, guys like you and I, can buy some small apartment properties. but that small buyer all the way to the institutional Wall Street level are in that space.
Mm-hmm.
And in some cases, the pensions love multifamily because it's a good way for them to spend $80-90 million on one asset. They have to place a lot of money, and the rent is there, the yield is there. There's internal management. But again, if it was just you and I purchasing, say, 20 apartments, you and I need to have a question of how management intensive is that? Are we going to be the ones dealing with broken toilets, the ice that needs to be scraped from the parking lot, the roof leaks, whatever, the hurricanes, whatever it might be?
Mm-hmm.
Or do we want something that's a bit more hands-on?
Yeah. PJ, the title of this webinar is like diversification or distraction, I think. And what you just hit on is, I think a number of potential investors say, I don't want the distraction of having to kind of worry about it, manage, et cetera. And I'd say to clients who have commercial real estate exposure that it's certainly possible for there to be distraction, but there are plenty of people who are in the business of managing properties. There are plenty of people who are in the business of developing a fund of the proper, private fund of developing these properties. So there's, you can, yes, if you own that 8-plex octoplex. If you own that 8-plex and it's you and you want to really roll up your sleeves and put down the ice when the snow is coming and deal and get the call in the middle of the night when the toilet overflows, that's a distraction. Potentially, but you can offload that distraction, and maybe the industry is designed to offload that distraction.
Management and how management intensive something is. Do you want to be completely hands off, or hey, we actually really want I'm a handyman. I like doing these kinds of things. Then that's great. I think that a lot of people who currently have assets, real assets in their portfolio, may very well be small business people who started out as small business people like you and I, and then eventually said, well, I'm going to stop renting. I might as well buy my own property and stop paying off somebody else's mortgage. And then, here we are, our investment company, whether you're a lawyer, a doctor, a physician, an accountant, a grading whatever you are, whatever career you have, you'll pick your head up 20 years from now and you say, wow, I've owned this building for 20 years and it's about paid for, or maybe it's paid for. And you say, okay, and I'm looking to retire. Now what do I do with that asset? Do I rent it?
Yeah. This is a real life problem. This is a real life problem.
Right. Yeah. And it's no different than somebody saying, okay, I've had a great run with these stocks, but I don't need the risk exposure of the Mag 7 or whatever it is. And so, hey, PJ, what can you and your firm do to help me reposition this asset in this silo into something that may be less management intensive? Or maybe I'm seeking yield and I don't mind dealing with the roof, whatever that might be. So we can have that conversation. And how do you want to leverage it? Or how much time before you really want to be pulling the income from this as income you're going to live on?
Right.
Versus, hey, we just want to pay this thing down as quickly as we can. So when we do retire, I'm not dipping in my 401k and watching that drizzle away year after year, month after month. And it's a great way to create that pension income, really almost in somebody else's dime. Or in this particular case, we use that structure to operate our businesses from, and it served its purpose.
Yeah, it's interesting. I mean, what you just described is again, it's an asset, right? A real estate, a piece of property or an investment in a fund, a private fund where there are actual properties that you understand the kind of more of those maybe parts. But that is it is no different than another asset. Maybe there's a high yield fund that is generating a little more yield in a portfolio. So now instead of getting 3.5% or 4% or 4.5%, we're getting 6 or 7%. Yeah, but that also comes with a little more risk. There's a little more zig and zag to it. So that trade off. Or we might invest in companies that have more of a dividend structure in there, right? So it's like, okay, this portion of a portfolio, if its job is yield, then then let's make sure there's an asset here that fits that. In your example, it's like, hey, if our goal is to generate some income with it, so we're not just thinking about paying off the debt, but we actually want to generate income. It's like, okay, well, let's think about the right asset. If the job in the portfolio is to produce income. I'm sure there are probably I mean on the real estate again on the real estate spectrum, it's like I'm sure there are some things that are far more speculative and growth oriented. Maybe you buy land or try to develop something. That's risk of kind of a feast or famine risk. It's on one end of the risk spectrum. The other end of the risk spectrum, it may just be kind of the your Chick-fil-A example. I mean, I guess any company can go out of business. So I'm pretty sure Chick-fil-A is unlikely to. But like an example, they'll sign a 15-year lease. That's a legal document that says they owe you this money. They're going to very, very likely pay every month. Yeah, the return's not as high, likely.
Right.
Although I don't know, maybe they. I mean,
But
but
they're
I'm saying
also
it's
responsible for all the maintenance of the area.
yeah,
I mean, literally, the roof blows off the thing, and they're not calling.
yeah,
They're still sending the rent.
right,
Right?
right.
And so you've got single tenant assets, you've got multi-tenant assets, you've got we could go on and on about different categories of commercial real estate. I mean, typically you're looking at 4 or 5 core functions. Retail, which we're all familiar with, local shopping center; industrial, which has had a lot of airtime, and particularly since COVID. And the last mile logistics and third party logistics has become more of a daily conversation than
Mm-hmm.
something it's really become mainstream.
Yeah,
Amazon's building last minute mile warehouses everywhere.
right,
So
right.
industrial has become an integral part of America's
Yeah,
economy. Logistics, it's not just logistics on how trucks are going to get from A to B. There's a lot more to it as
yeah,
well.
yeah.
And there is some exposure in that space. There's big REITs, Prologis, and some of those kinds of companies if you wanted some exposure without owning them. But that's a really great space. They're typically low maintenance tenants, and it's really just a big box.
Yeah, right,
People aren't
right.
showering there. They're not raising their children there. They're
Yeah, right. Generally,
all these kind of intensive things that people do in real estate. Industrial's been a really great asset category for the long term. And then office. And office has actually kind of been the stepchild here ever
hmm
since with COVID. And that's been a lot of interesting literature about, office vacancy and how do we turn this office building into apartments or
right.
reuse these old buildings. Or they may not necessarily be that old. And we're seeing people really not going back to the office. So there's been a lot of dialogue on, is office the sector to be in, or is it office the sector to be out of? And
Yeah,
I think that really depends. Probably one of the most geographical plays in
yeah,
today's.
yeah, yeah.
They always talk about real estate being, location, location, location. Well, that's true. But as a professional and somebody that gives guidance on this for over 25 years, it's really more about disclosure, disclosure, disclosure. And what are we looking at not only today, but 2 years,
Yeah,
5 years, 25 years from now? And is this, a near term player or a legacy?
yeah,
And then there's a lot of chatter about multifamily, and there's, always the kind of the splash. We went through the storage trend, and we went through the car wash trend. Now we're seeing the service station trend really come back with gas stations. So there's always kind of a trend, but I always really stick to the core assets, and you can buy some good real estate and clip some great
yeah.
coupons for a long time.
Yeah, it's. I mean, those. It. I mean, I'm sure, like any investment, it's cyclical, and there are. It's okay. We haven't had maybe office build out in a while, and so maybe there'll be a time where people feel like, all right, maybe we're light on office, or we hadn't had industrial, so now we got to build that out, and it's so there is and that supply and demand. Push and pull is real. Also, you mentioned like a Prologis or any other REIT or where you can go out and own a security. There are a number of them, whether it's apartment REITs or and it is. And I used to work. I used to work for a REIT, a self storage REIT, when I was in Seattle, and I sat next to the head of the director of real estate and real estate acquisition, and it's notable in that space because it was a time when all you had to do is build a buy the dirt, put up the self storage, and it filled 80% up within 6 months, and then you could kind of clip your coupons, and it made sense. And I thought, man, this is what a stable, steady business. But because it was a traded asset, there'd be years where the stock was down 15%, but they were making as much money as the previous year. And it's like that is an element of actual real estate exposure that is just fundamental. It doesn't zig and zag. Now the value of it, I mean, you certainly don't. I mean, it's not, you don't trade it, right? So you don't put, monitor the value from 9:30 to 4 o'clock. You don't watch your office building go up and down in value all day long. So I mean, there's some element that's just built into that component for the REIT, but there is also a real sense of, look, if this month versus next month it's the same tenant paying the same rent and all the expenses are the same, then the building hasn't lost value likely, or certainly hasn't moved much. Where the REIT could drop with interest rates or with an order, or if a peer, if another self storage REIT struggles, then I say, well, if they're struggling, maybe Sugar is going to struggle. And so the volatility of a REIT is amplified because it's traded, and so it depends what your goal is. I mean, it's also, by the way, it's liquid. If you want to not own your office building or your apartment complex tomorrow morning, that's a problem.
That's a problem. You hit the nail on the head. And just real quick, commenting about the storage. Look at hospitality and look at what's happening with the hotel sector. From prior COVID to now, kind of a similar, except the difference with the office market, where you're still running nationally, you're still running 20+% vacancy factors. You can't put enough hotels on. I mean, look how many hotels have been built in Wilmington just the last 5 years. I mean, there's two a year, right? Probably about double the supply. And so, you do have to be a little bit careful about what market segment you want to get into. And again, what age are you, and how much money do you have to allocate? How much of the bucket are you going to reach into and say, all right, we're going to take the money out of this bucket and put it into another bucket. It's still in my control. It's still in my portfolio.
Right.
But now maybe it's time to get away from equities and put a little bit of money into commercial real estate. And so, kind of back to the spirit of this webinar today is, how do we do this and why do we do this? And the REIT, again, the stock price, to your point, is not probably a direct reflection of the actual value of the assets. And so, and again, I can't leverage it.
Yeah. Yep. I mean, there may be leverage in the REIT, right? But you don't get the advantage of putting fewer dollars into leverage, right? It's that's right. Yep.
But to your point, liquidity is probably your biggest hurdle when it comes to real estate. Let's face it. There are certain times when certain markets are on fire. The housing market a few years ago, you sell your house in an hour. But it's still going to take 30 days or plus or minus a month or 45, however many days before the closing takes place and you actually put your hands on that couch. Now, if you and I had, for example, we go back to the office building or whatever real estate you own to operate your business, once you've got a sizable liquidity in that asset, you can go to the bank and borrow some money against it. I mean,
true.
That could happen inside of a week. I mean, that's not a long, drawn out mortgage process typically. And even if it is, you're still only talking a matter of a couple of weeks, as long as you've got liquidity in the asset. But at the same time, I'm probably not selling that asset within 30 days and closing on it within 30 days. So the liquidity component is definitively one of your biggest drawbacks when it comes to real estate.
I mean, I think that's fair. Of course, I would also add that occasionally it's a plus, and that is in my example of, I want to get out of my apartment complex. I read an article and I'm worried about it. Pull the trigger, I'm out of it. Or apartment complexes start to drop, and it's kind of like, oh gosh, better get out. Maybe that's the worst time to get out, right? And so if it's in a REIT, you're out of it and you move on and it rebounds. You never participate. If it's your apartment building, you say, well, sometimes rents are good, sometimes rents are mediocre, but I'm sticking with it. You don't kind of jump off the ship, too early because you can't. Because you can't. By the way, that actually what you said something too that reminds me, especially at a time in the last few years, we've certainly so liquidity is something I think people think about. Inflation is something people think about, and we've seen some inflation, and you could make a pretty good argument, I think, at least historically, economists have that a real estate's a great asset to have in an inflationary environment. I mean, your tenants are paying more every year. I mean, you can inflate your income with that
There's
asset.
no doubt that real estate values, real asset values pace with
Yeah,
inflation. The downside is that your tax bill is probably pacing with
that's right.
inflation as
That's
well.
right.
But to be open book here is that they're
Yeah,
but you're right. It's typically going to pace,
yeah,
which we experienced really in real time here over the last 3 to 5 years for sure.
yeah, yeah. I think about rents moving up, and it is so. It's. I mean, I guess really, actually, and this is maybe an epiphany I should have had years ago. But I mean, it's. I mean, it certainly is a diverse asset class in terms of the types of properties. It's certainly a diverse asset class in terms of geography. Truth is, it's also a diverse asset class in terms of it depends on your goal. Your goal. I mean, you can be on any of the points along the way, depending on your goal. So for my clients, as an example, right? I think, okay, it would be nice to have a non correlated asset, like to pick up some income, and maybe there'll be some internal leverage. I'm still using my dollars dollar for dollar, but inside the fund, like a private fund, for example, if they're putting 30 or 40% down on a property and they're leveraging the rest of it, and 5 years later they sell it, that leverage accrues to my benefit, right? It doesn't accrue from the standpoint of if I'm putting $100,000 in or $200,000 in, I can't leverage that, right? That is whatever it is. Those are the dollars in, but at least there's a leverage element inside the fund. So I think about clients will say, how much should I have exposure to this? And I'd say, well, it really depends on your goals. If inflation protection is important, if income is important, if liquidity. I mean, these funds are not easy to get out of. you know and I mean by their I mean that by the way, that's not a knock on the fund. It's the nature of the fund, right? You can't come in. I mean, it's not a stock or a fund traded. I mean, it really is a portfolio asset. It's a portfolio asset in the truest sense. It's goal driven, and I think too. I mean, it's used an example earlier about people are getting, let's say you own a business. Let's say you're a dentist and you put your head down, and 20 years later you wake up and you're like, oh man, I've developed a good practice, still on my building. I don't own any debt on it anymore. I don't hold any debt on it anymore. Those are it's you know and I've got clients who are in this boat, and they think, okay, now I've got an asset. Do I just keep it and have somebody else, the new dentist, come in? Right. I said, well, maybe, but that's a single asset. I mean, that is, if you sell this asset, you got to think about the tax implications. Maybe sell this asset. Now you could, diversify across 4 or 5 assets or 2 or 3 geographies potentially. So just like any other investment, you got to look at the characteristics, and you got to match those characteristics to your goal.
100%. And in your case, to the dentist, they know that business.
Yeah.
So you say, hey, you know what? Maybe this dentist office is tired, and with technology and equipment and everything else, potentially it's time to just hey, let it go. There are, and we don't need to get into 1031 exchanges, but there are ways to
four-letter word.
Take that money and reposition it without necessarily having to pay Uncle Sam.
Yep.
Or you maybe say, hey, look, dentist offices are typically capital intensive, and they're probably going to rent for a lot more than your typical office building because of the way it's set up.
All the infrastructure and everything, and the fixtures.
The parking, everything that goes with that. And, hey, it might be $5,000, $10,000, $15,000 a month in rent to that dentist who's retiring, but the building's paid for, it's built-in cash flow. Or to the point you just made is to say, hey, Mr. Dentist, this building's probably past its day of being a dentist office, but it would make a great daycare. I mean,
Right.
whatever you
Right.
reposition the building for,
Right.
reposition the asset.
Children love dental chairs,
No,
so it's great. It's perfect. I mean, it's seamless. Seamless.
college kids do too.
College kids.
but, but upside down margaritas or whatever thing. But you can take that money and reposition it into multiple assets, multiple locations.
Yep.
How many clients do we have that have a second home in Florida, Arizona?
Yep.
There's a migration to Texas. There's no question there is a flight of people out of the Northeast, and they're moving to warmer climates. And so, however you want to position that money to take advantage of not only the growth from the growth of an area, but the growth of the asset and the rents that come with it.
Yeah. So by the way, and I'm aware of time. We got maybe 5 or 10 minutes or so left. But it is the migration of, I mean, I mean, geography matters, right? And there are asset classes that work well in some markets and not as well as other markets, et cetera. And so when people come to you, and I know you have got not just a local client base, but you've got folks who are coming to the area and folks in different businesses. They're coming and asking you questions, right? They're coming from different areas. When people look at investing, I assume they mostly come to you with an idea in mind, or do you have to say, look, let's walk down the path of what the options are in this market?
Well, that's everybody's got a brother or a cousin or a nephew or somebody who's an expert, whether they were in construction. Most people retire, or when they go into retirement, and their most valuable asset's their house. So they're familiar with owning a house. They've been through the mortgage process probably at least once, if not several times over, raising a family, migrating, moving, whatever the case might be. So I think that's part of the reason why so many people walk in the door wanting with an attraction to apartments.
Yeah.
It's commercial financing, but it's really a lot of residences.
That's right.
That's
right. It's very understandable. It's very understandable.
It's understandable. Where, a lot of people, how many people really have even been in a big warehouse?
Mm-hmm.
Industrial used to be kind of a creepy place. It was there, industrial parks were, they're
chain link fence,
area, right off a highway, kind of a freaky spot. It's not, you don't stop and go, yeah, let's pull into the warehouse.
But
people trying to better understand the move of the industrial, that silo is one where it's not unusual for people, to your point, to walk in and say, my cousin's done really well with apartments. I want to buy apartments. Yeah. Okay, that's great. But let's talk about the positives and benefits and the drawbacks of owning multifamily. Yeah. And same. And, there's a very popular investment opportunity that a lot of people lean on now called flex space, which is a little warehouse. It's got a little bit of office in the front. It's got a warehouse in the back, and it's
a mullet. It's like a mullet. Business in the front, party in the back. No, maybe it's an opposite of a mullet. I don't know. Maybe it's opposite. I mean, I'm not a hair guy, clearly.
But again, that's one of those ones where if you were looking for just about the closest thing to a recession-proof real estate investment, that's it.
Mm-hmm.
I mean, because if you've got 10,000 feet of warehouse space and time's going bad, you got to shed some employees, and I need to shed stock of inventory of equipment, you can simply downsize into a smaller warehouse. And same on the upside. So you see, I mean, literally in Wilmington alone and in coastal markets, the vacancy factor for all of these assets is single digits. So that means that your buildings are full. Whereas in other potential markets, that's not necessarily the case.
Mm-hmm.
And so that's, the question is how often do you want to see tenants come and go? How management intensive do you want this thing to be? How involved do you want to be? Or do you want to hire a professional management company, which there's tons of them. So that's not a problem, but obviously they're going to take a little bit of your income comes out of that.
Right. Yep. Yep.
And so I think a little bit of it is, what are people familiar with and what are they comfortable? And then talking about, okay, well, if you've got potentially 15 or $20 million to spend, we probably want to spread that out, just like they would if they came to you.
That's right.
Oh,
that's right.
Million. Are you going to put all of it in Apple? Of course not.
Right.
Right. Yeah. So great company, but I wouldn't recommend.
That's right. That's right.
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 So
right.
That's a way to potentially spread that out and take advantage of when like one market, when one's hot, one's cool.
Yep. Yeah. And if you're in it for the long haul, right? So I mean, actually, this is a great way to kind of this is exactly what this kind of the whole conversation is about, right? It's like, look, it depends. You invest in real estate not because you think it's going to pop and you're going to get out of it, right? It's just an asset class that doesn't work in that way. You invest it because it's going to help you diversify your overall portfolio. You invest in it because it's not going to correlate to the stock market. In fact, you might argue some types of real estate have a negative correlation. Market goes down, they're going to benefit. I mean, potentially. Certainly, there's not a direct correlation. It's the inflation element, the potential tax benefit. I mean, these are all as you describe. It really is similar to conversations I have with clients, whether it's day one or day 10,000. It really is day 10,000 is pretty. That's pretty far away. Whether it's year one, year two, when we have more conversations, if risk tolerance changes, if total wealth changes, if goals change,
loss of a family member.
That's right. That's right.
I mean, cancer, whatever it is, life happens.
Right? Life happens.
That's right. And so, one thing that I really want to commend you as an asset manager is putting this to limelight, because the sooner you can get into a real estate asset, the younger you are, the sooner that you can get in, the better off you're going to be when you come close to retirement, because you've got the asset paid off. And that's where the magic is, right? That's where the money's not flowing back to the bank for the mortgage anymore. Now or you've got enough liquidity in that deal, whether it's just a single family home or it is apartments or it's storage or whatever it is.
Yeah.
You can now go to the bank and say, okay, I've got $1 million in liquidity in this, whatever, and I can borrow $400,000 or $500,000 of that, take that, and lever up and buy another one and buy another one. So over the course of 20 or 30 years, we can retire. And the other thing is so the sooner you can do it, the better. But I really commend you, and I just want to give you a quick plug because I know we're short on time. Most asset managers don't push real estate because you don't get paid.
Right.
When your client buys an apartment building.
In fact, I typically lose assets, right? Right? Assets are now being managed outside. Yeah, that's right. That's right.
They're selling the assets that you're managing and putting them in a different bucket. Correct. So I really commend you for that, because there's not enough people in the asset management space having a dialogue about real estate with their clients.
It is. I will accept the commendation. But it really but all it really is saying, just like you start your conversations with your clients around what's our goal. Look, if the goal is, if real estate matches the goal, then it should be in play. It should be in play. And it's in some ways it's easy because I can sleep better at night knowing, look, real estate was the right way, is the right asset class for 20% of their wealth, because of this is their goal, this is their risk tolerance, this is what they're looking to achieve. And it's like, this is a classic, they should have some commercial real estate exposure, right? And so it's okay. So I sleep better.
And you know firsthand. You own real estate. You have partners.
I mean,
you know how valuable this can be. It's not the get rich quick. It's the one of my best friends always says is, PJ, the hare doesn't always win the race. And this is a perfect example.
Wait a minute, the hare doesn't win the race? Did I misunderstand the parable?
The rabbit.
Did I misunderstand the parable?
The turtle wins, Pohlman.
I didn't. Unbelievable. I had that parable all wrong. I'm like, that hare is so fast. That's the moral of the story. Go as fast as you can. Oh my! Here I am, 50 years old. Then no, it is true. It is true. And real estate is the ultimate example, really, of that story, right? The tortoise just puts one foot in front of the other, and before they know it, they're winning the race. And yeah, there may have been times when they were losing. There may have been times, and certainly it doesn't. It's not as fancy an asset, not as fancy an animal as a rabbit. But actually, that analogy really is spot on.
You put your head up in 10 years from now, the kids are going to college. But sure, I'm thankful I've got an extra $1,000 a month coming in.
Yeah, yeah, and an asset, and also an asset.
And I still own the asset.
You still own the asset.
Still own the asset.
Yep. Yep. So, thank you, by the way. This is great. I will for anybody, for the throngs who are listening, and will listen to this. This is an asset class that most folks should consider. Now, whether or not they should invest in it, who knows? This is just as educational. And I'll pop my disclaimer up in a minute. But this is an asset class that is to be discussed. PJ's great at it. I've got firsthand experience. I've got secondhand experience because I've heard him in meetings and speaking into groups. He's an expert for sure, but more than that, I think he's probably a listener more than some, maybe even more than most.
What'd you say?
And what's that?
What'd you say?
Get it? Oh, wow, it's good stuff. Good material. No. He is a listener, even though he's but it's and I know because I've seen it. I've seen it. And the ability for somebody who invests in a narrow asset class, or helps people invest in a narrow asset class, you tend to, the blinders can get on real fast. And so kudos for not just, this is what I'm selling today. But I know you're available if anybody wants to kind of, discuss further. I certainly think that is for some folks on this call who've been thinking about it. This is an opportunity. Reach out, and if you want to, if my clients or anybody else is on this call who thinks I'd like to think about where commercial real estate falls in our portfolio, I talk about this with clients all the time, so it's a natural conversation. I know, PJ, you literally are helping people all the time on this, so hopefully this was helpful. And maybe most importantly, it is. I'm just glad that it's a conversation that's happening, even even just us or a group. It's important for people to get you said this exactly right. It's one of the asset classes that you really have to be disciplined enough to get in early enough to let that kind of tortoise win the race. You investing early. This is true across a lot of investments. Boy, is it certainly true in the real estate world. Being able to invest early is a big deal.
Let's face it. I mean, if it wasn't for real estate assets, I don't know how. Because you can't rely on Social Security. And yeah, I've got, a stock portfolio, but how long is it going to last? I don't know how long I'm going to live. I don't know, is it going to go up? Is it going to go down? So, but anybody who would love to have a conversation with me or with you or jointly, even better, we'd love to do it. Thanks so much, Matt.
Awesome. Yep. No, PJ, it's a pleasure as always. Here's our disclosure. This is educational. But hopefully you guys will learn something, and look forward to our next webinar coming soon. PJ, thank you again.
Thank you, sir.
Yep. Thank you.